Welcome to part one of a three-part series titled Doing Good Gives You a Tax Break. My name is Taylor Bentu, and I'm the Financial Paraplanner for APC. I'm here to introduce you to our expert on this topic, Joe Ottaviano. Joe is a certified financial planner and the Vice President of APC. He has his MPA from University of Texas at Austin, and he has a background in accounting, which gives him a great eye for tax strategy. He's going to share today from both professional and personal experience how to pay less in taxes and give more to charity. Over to you, Joe.
Thank you, Taylor, and welcome audience to our part one. And this topic will be around qualified charitable distributions, or QCDs. And we will talk about bunching in part two, and then donor advised funds in part three. So let's start off with qualified charitable distributions and what a QCD is. So if you are at least 70 and a half years old and have an IRA, then you are taking required minimum distributions, or RMDs, from your IRA, which the government, of course, will tax. But you can, with a qualified charitable distribution, elect to have some or all of your RMD, in fact, up to $100,000 per year, redirected to a qualified charity of your choice or charities. And a QCD, as the slide says, can satisfy all or part of the RMD amount. From a tax standpoint, RMDs are included in your adjusted gross income. So if you look at the front of your tax form, you'll see adjusted gross income at the bottom of the tax return of the 1040, and therefore those are taxable. Whereas with a qualified charitable distribution, that is not included in your adjusted gross income because you elected to have some or part of your RMD go directly to a qualified charity or charities. There are many, many advantages of keeping the adjusted gross income as low as possible, and I'll just cover a few of those. One would be lower Medicare premiums for both parts B and D, which are both triggered off of gross income levels. The other example would be medical expense deductions. You can include in your itemized deduction schedule, Schedule A, medical and dental expense deductions that are over and above 7.5% of your adjusted gross income. And then finally, there's a Medicare tax of 3.8% on net investment income for high income earners that is also triggered off of adjusted gross income. But there are so many other areas that are affected by the adjusted gross income, hence why you want to keep that as low as you can, and qualified charitable distributions allow you to do so. So let's look at a real life example of a married couple that are filing jointly, where they have $100,000 of income from various sources: pension, Social Security, wages, etc. They have an RMD of $25,000 and a total adjusted gross income of $125,000. They also have itemized deductions of $20,000, $4,000 of state taxes, $6,000 of real estate taxes, and $10,000 of charitable contributions. And their standard deduction, which has doubled this year from prior levels, is now $24,000 for married filing jointly status. So the standard deduction, because it's greater than the itemized deduction, would be used to net against the adjusted gross income of $125,000, leaving them with a taxable income of $101,000. The tax owed on that would be approximately $14,100. Now, let's say that the couple elects to have $10,000 of their RMD go directly to a charity or charities through a qualified charitable distribution. What that would look like then is income would remain the same, but their RMD would drop to $15,000 from $25,000, leaving them with an adjusted gross income of $115,000. Their deductions, because they now have elected to have that $10,000 of charitable contributions come from their IRA or IRAs, is now zero, and their state taxes and real estate taxes don't change, so their itemized deductions are $10,000, but they would still elect to use the higher of that or the standard deduction. Again, the standard deduction would be higher. So that would take their taxable income down to $91,000, and tax owed on that would be approximately $11,900, or a whopping tax savings of $2,200. Now, who in the audience wouldn't want to save $2,200 in taxes? So please consider qualified charitable distributions as you look at your tax planning for this year, as well as continuing to be generous to those organizations in need. And with that, I'll turn it over to Taylor.
Thank you, Joe, and thanks to everyone who is listening. If you have any questions or comments, please feel free to reach out and join us for parts 2 and 3 of the series. Until next time, have a wonderful day.